Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing podcast. I am your host, Real Estate Cody, and with me, as always, the one and only coffee connoisseur himself, Mr. Brian Alfaro. What is up, my man? How you doing?
Cody, good morning. So nice to see you. It's a beautiful day here in Houston. We've got some big things going on. Year started off great. Really excited about today's episode. Pleasure to be here.
It is always a pleasure to be here, and always great to have another awesome conversation related to our specialty here, which is multifamily investing. And we're got a special episode today, right? We're going to talk a little bit about kind of the flight to quality right now and why passive investors really should be leery, and I use that loosely, but leery of the value add play right now in this market cycle. And I think it's really relevant, right? I think it really kind of starts back probably many years ago, even pre-COVID, but even post-COVID, just with this rapid, accelerated asset valuation that we've been seeing and a lot of the aggression in the marketplace fueling this demand for multifamily, which is driven a lot of crazy pricing in the marketplace. So that's going to kind of be the core basis of our conversation. What do you think?
Well, I think it's going to be a great conversation. We've had a guest on the show a few episodes ago, Mr. Bill Ham, who's been talking about the flight to quality. I feel like for a couple years now. Maybe he was a little bit ahead of the curve, and that's why we like Bill on this show. But he's been talking about the idea of value add sort of being overplayed. In our last guest, we actually mentioned that as well. And it doesn't mean there aren't great value add strategies out there. They're just getting harder and harder to find. So I think talking about this topic today is really important for all of our listeners who are interested in investing with us or other operators. Just to doesn't mean stay away from value add necessarily. It's just something you have to be conscious of knowing today's market cycle.
Yeah. So let's kind of talk about let's first start off about the idea of value add. So the traditional value add model has really been very popular over the past however long commercial real estate investing's been in place, but really over the past decade, I think is where when syndication really became more mainstream and retail level investors actually started having access to these opportunities, you really saw this massive influx of owner operator syndicators coming into the space chasing the value add strategy, right? And so when we think about the value add play as a concept or a strategy, typically what that would mean is you would go and buy distressed properties, whether it be physical condition or in operations, and you would buy that property at a steep discount and turn those operations around, improve some of the deferred maintenance or, the poor condition of the property. And then you would reposition that property right back into market rate for a substantial, income upside, equity upside, which generally would yield you a pretty significant cash flow and equity position, right? And we've seen that model played out over and over and over the past decade. So what's interesting though is looking back because of this continued influx of new investors coming in and pursuing this strategy, which is being taught across
Sure.
multiple different coaching programs, right? I mean, there's just a plethora of coaching programs now, and they've all been teaching this high yield, high return type of investments. You started to see a deviation from, I say a deviation, you started to see this kind of pattern of people getting into properties, acquiring opportunities, putting lipstick on the pig, so to speak, and then turning around and trading it to the next guy 2, 3, 5 years later, and then just rinse and repeating, rinse and repeating, rinse and repeating, right? And it's created this like evolving cycle of passing the buck.
Yep.
Would you agree?
Hot potato.
Hot potato. That's right. That's right. So, um, and you look at think about 2000 and I don't know 2010, 2011, right? We're coming right out of the Great Recession. Take Houston for example. You could go buy that value add deal for 30K a door. You can't buy that same deal close, even anywhere close to that now. I mean, your value add deals right now are trading at a sub four cap, call it three and a half cap, mid three cap. So it's just really crazy to see that accelerated, asset valuation appreciation. So now we're in this very interesting dynamic where you now have these older properties that have been passed around like the hot potato, as you mentioned, that have yet to have the underlying infrastructure of the buildings, either replaced or patched or brought up to current building codes or standards in today's time. And you have guys that are going out there buying these buildings on a premium, right? I
Mm-hmm.
mean, just there's no discount anymore in the marketplace
Sure.
whatsoever, unless you just are absolutely buying in the hood, so to speak. So, you know, before we keep going down that rabbit hole, did I miss anything? I mean, what are your thoughts so far on
No, I
that?
think you hit the nail on the head. The value add play is something that was very attractive, and it still can be. And it's where a lot of new investors cut their teeth. We say that quite often, and it's just something that a lot of educators and a lot of, I use the term guru lightly, but people that are educating other people in the space, which is, there's nothing wrong with that. If I got started in multifamily 10 years ago and I was buying value add deals and having a lot of success, why would I not want to share that with the world and show them the power of value add as well, right? So it's a formula, it's worked, it can work for other people as well. I'm going to go and I'm going to educate others, whether that's through mentorship or coaching or just one on one training. So completely understand the business model. But the problem that we're sort of seeing now is that it's created a lot of new investors, including us when we entered the space, that were exclusively chasing value add deals. And the definition of value add deals has sort of changed over time, where 10 years ago, they were legit value add deals where they haven't been traded in 20 years, they haven't been renovated in 10, 15, 20 years. And you could truly go in there and improve the quality of the tenant's life, raise the rents, and produce a significant return for your investors over a very short course of time. Call it 2, 3 years. Nowadays, people are paying a premium for those same opportunities. We say this, you see this every day, Cody, being, ahead of our acquisitions, where you're paying a premium for the opportunity to add value. The cap rates for something that has a value add component are lower, arguably sometimes, than the A class, more stabilized opportunities, which can be a little hard to wrap your head around. Like, why would I pay more for something just because it has a little bit more upside versus paying for something the same price or the same cap rate, I should say, for something that doesn't have that same large value add component but is more stable, right? So, and that's when we talk about execution risks and all the other factors that can kind of come along with it. But I think we're in this cycle or this sort of turning of the guard, so to speak, where the road's kind of pivoting and it's going in two different directions than where it has been going for the last several years. And I think you're starting to see more savvy, not educated, experienced investors starting to pivot towards the higher quality deals because they're noticing the same thing. So yeah, we got a whole onion to peel back in regards to that topic.
Yeah, no, you brought up a lot of great points there, Brian. And I think, we put out a really good blog article several months ago about looking at the risk adjusted returns and talking about the
Mm-hmm.
risk adjusted basis, right? And to your point, you just mentioned, right? What have we seen over these past several years? Where there used to be a spread in the premium for a C class product versus your A class product has now merged to where there's little to no spread at all
Mm-hmm.
across the asset types, right? Again, if you're buying an A class product on a three and a half cap, it's not uncommon that you may be buying the value add product on a same three and a half cap,
Mm-hmm.
you know, which, I mean, we haven't been around multifamily for extensive amount of time, but I have yet to hear an investor speak to a market dynamic of such where we've seen, that elimination of that spread in between the two asset classes. And so what you really have to ask yourself now is is paying that premium worth the execution risk that you're taking, right? And again, not to say that there's no value add opportunities out there, but the label value add really is now have been overplayed to an unfathomable degree because everything has a value add label slapped on
Sure.
it, right? Sticks in the ground going vertical, it's a value add. New delivery, it's a value add. Everything is a value add in today's marketplace.
Well, it's a
And
sales
so
pitch, right?
it's a sales pitch.
I mean, it's a
That's
sales pitch
exactly.
for investors, and it's again, it's not that it can't be done, but the term was used because it's, in my opinion, it's easy to grasp, right? If I'm an investor, an accredited investor, I have a high net worth, a lot of liquidity, and I want to put my money to work in real estate, but I don't know anything about real estate. Maybe I've made a lot of money at my W 2 or in the stock market, cryptocurrencies, equities, whatever it may be, where you've built your wealth. But and you want to get into real estate because you know how attractive it can be. It's a great investment vehicle. You want to diversify, but you don't know much about it. So you kind of start with the basics, and everybody knows that the basics of real estate is find something ugly, make it not so ugly, and that improves the value, right? It's the basic house flipping. Everybody understands that model, right? Buy a house under market, renovate it, resell it, flip it, make a profit. Everybody gets that. And it's applying that same sort of mentality, the value add mentality, to apartment buildings or whatever asset class you're in, that you're going to buy something that hasn't been taken care of, hasn't been operated well, needs some cosmetic maintenance, has some deferred maintenance. You're going to go in there and improve the value of the property, which is totally reasonable and legit. It's needed too, by the way, because we have a serious shortage of affordable housing in America. So I'm not saying it's not a good thing; it's a great thing, but it's essentially a sales term to tell investors what we're doing. We're adding value to the property. We're making it more valuable by doing these things that need to be done. The problem is, as we've been talking about now, we actually have to pay a premium just for the opportunity. But I think it's important to understand that that term is a sales pitch, so to speak, and you can really, like you said, you can add value to anything. We can go buy a 2022 build and add value to it, right? We really can if you're creative enough. I mean, it goes back to just finding opportunities, finding a way to sort of add value, so to speak.
Yeah, but that's the other point I wanted to highlight too, is what you brought up is that premium you're paying now. It's a fundamental shift from before, where you were looking at the in place value based
Mm,
on, financial performance, versus now where you're now paying that premium up front for the
pro
future
forma.
projected performance, right? You're buying on pro forma now.
Yep.
And for a lot of investors, it's very uncomfortable. And, let's be frank, I mean, that's where the execution risk is.
Hmm.
You have to go and now exceed or meet or exceed those projections in order to justify that valuation that you're paying for at closing when
Yeah,
you're acquiring the
100%.
asset.
I mean, the whole theory is based on execution risk.
Right.
It's really what the whole, like, why would you go from C class to A class, or why would you go from light value add, or what we call value A class? It's the term we've been using, those B plus A minus opportunities. And it's really execution risk depending on your outlook. And a lot of people, some people think the reset button was hit in 2020 and we're on a new total market cycle and it's nothing but on the way up. Some people think we're about to crash. Some people think there's a soft correction coming. I don't think anybody really knows what's going to happen, but I think at almost everybody you talk to understands that there's risk involved with investing in anything from the stock markets to cryptocurrency to real estate right now, because there's a lot of unknowns. We've never gone through something like COVID before. The Fed doesn't know what they're doing. They don't have a rule book for this. It's a new circumstance. So there's a lot of unknowns. So because there are so many unknowns, you have to ask yourself, as an operator, we're the people buying the assets, and then for our partners that want to passively invest with us and go along for the journey, is how much execution risk do you want to take right now, because there's so many unknowns in the market right now. And for us, our appetite personally, and then especially for our investing partners, our passive investors, the feedback we've heard when we were talking, I know when I was talking to a lot of people during COVID, one of the number one questions we got is, what do you think is going to happen in the market? What do you think is going to happen in the market? So there's a lot of, I wouldn't call it fear. People understand real estate investing always has an element of risk, but it was uncertainty. And to me, one of the best ways or options to mitigate that uncertainty is to just buy a higher quality asset, right? If you know something bad, or a correction might potentially happen during the hold period, wouldn't you rather be holding something that doesn't have that execution risk, labor shortages, lumber prices, all the other challenges that kind of come along with something? These value add plays take 18 to 24 months to completely renovate 150, 200, 250, 300 units. Do you want to sort of get caught with your pants down, so to speak, during that value add play? Or would you rather take something that has maybe a little bit less of a return, slighter yields, but doesn't have the execution risk that comes along with renovating that property? So it really comes down to your investor appetite. But I think all those are great points to make when it comes to this value add play.
Yeah, exactly. I like to use a very silly but basic model to understand. If you were told that you have to drive the same car for the next 5 years, would you rather buy or hold the 1980 beat up hoopty that has 200,000 miles, knowing that you're going to have to continually put in capital to make sure that the engine's maintained, make sure that the wheels don't fall off? Or would you rather have the, new Mercedes that's just, you're still buying a premium, but at least it's well operating, it's newer, it doesn't have the wear and tear on it and whatnot. And so it seems like a silly model, but really that's kind of it's a perfect example of where we're at right now, where that's the dilemma you're being faced with. You're buying an asset that just like you said comes with a package of unknowns and uncertainty, and you're paying that same premium as if you were buying the Mercedes, and you're crossing your fingers hoping that everything plays out. And listen, there's guys that were buying in 2017, 18 that now look like geniuses when other people were saying, "Oh, the crash is coming, the crash is coming,"
Sure.
and they've done very well for themselves. But we're now in an interesting dynamic going into 2022, where the Fed is tightening up their monetary policy. Interest rates are all but guaranteed to rise. Now, how far, we don't know. And so now the question becomes is how have you projected that circumstance into your business plan to make sure that you can weather that storm? Because ultimately that's going to impact your ability to refinance and to either stabilize debt or whatnot. And then we have dynamics like supply chain interruptions,
Yep.
higher input costs on construction materials, labor shortages, all these factors that are really playing into the to that they're impacting the value add strategy, especially when you're going and implementing a capex strategy. And again, it just really kind of it bodes the question is what is your risk tolerance right now? Is that suitable for you? And if it is, great, then I'm sure there's plenty of opportunity out there. But I agree with you. I would argue that more investors right now, because of the uncertainty, are looking for something that's a little bit more predictable, something that's a little bit more secure, whether that be on the debt side or operations, but something that they could at least sleep better at night knowing that, the plumbing is not going to burst overnight, or there's not going to be electrical fire, or, something of the sort. There's foundation issues that come along. So, and I don't want people to, again, I don't want the conversation to be solely on, never do value add again.
Sure.
Look, it's all, like you said, it's a risk adjusted basis. When you can buy a building right, hey, that's the key is can you buy it right? And that's really the point of the argument for today is what is buying right? What does that mean to you as an investor? And it's subjective.
Sure.
But I agree with you. I think right now, getting into a more stabilized asset, newer building that doesn't have some of those execution risk variables that come along with it makes a lot of sense right now. Makes a lot of sense right now. And that's where I think passive investors really need to be thoughtful and intentful when evaluating their next investment opportunity. Number one is figuring out what your risk appetite is, what your risk aversion is. And, you know, we're seeing tighter and tighter yields. And this is the other dynamic too, right? Is where used to you would have a higher risk, higher return
Yep.
on your value add play, right? Typically higher cash flow, higher equity multiple versus your more stabilized product, your core product. You're no longer seeing that spread anymore. Your value add deals are really producing the same returns as your core plus assets, your stabilized deals. And that's also another interesting dynamic. So the question you have to ask yourself is that execution risk worth the same return when you can go buy the newer, well-performing building?
Absolutely. Yeah.
And
And go
oh,
ahead.
go ahead.
Well, I was just going to say, with the we still love value adds. Again, this is not an episode about why value adds bad. If you can find a great opportunity and the numbers actually make sense, and you feel like the risk adjusted reward makes sense for both you and your passive investor partners, then absolutely you should go after it. But I think it's just, time is something to always be a component of or considered of when you're investing in these opportunities. And a lot of times you're seeing in today's market, at least, you might not be getting any returns for 12, 18, 24 months during a value add play. And it's not uncommon that you see operators sort of covering up the fact that there's risk involved with like a pref model, right? Which kind of aligns with our investing thesis and why we try to lean really heavily on just a straight equity split. Not that we would never do a pref, but it's situational, so to speak. But at the same time, if you're in a pref model and the deal's not cash flowing, even though you're in a pref, there could be a catch up there where you think you're getting 6% pref, 7% pref, 8% pref, or whatever the term may be, because there's a value add component. But at the end of the day, you might not be getting it, or it might end up being something that you get caught up on the exit, which again goes back into if the deal doesn't really hit its performance metrics for 2 years, for example, or 3 years until a refinance or an exit. Even though there's a pref and you feel like that's some sort of safety net, like, oh, I'm going to get my 7%. Well, no, it doesn't mean you're going to get it every month if there's no cash flow, right? So again, it just goes back to understanding your risk, your appetite, the operator, their experience doing that as well is obviously a huge component of it. If it's a great team that has a track record that you've invested with before, that you trust, that if things went a little rocky, so to speak, you have trust in their decision making, then that's totally fine. You should totally, can still consider those opportunities. But there's so many variables to this that we want to make sure people are educated on before they make an investing decision, whether it's A class or C class. You just got to know your risk appetite, know the variables, the strings that can sort of be pulled to make the deal a good deal or a bad deal, and just go in and make the best decision for you and your investing thesis.
Yeah, absolutely. Because the other point to that too is not only are people trying to get more creative in their equity structures, but a lot of operators are being forced to go into secondary, tertiary markets to chase the higher yield, right?
Sure.
Because that's what their investor appetite is commanding or demanding, right? So, and that's another risk profile that somebody needs to be aware of. There's a very different dynamic when you're going from a primary market to a secondary, tertiary market, especially when it comes to chasing yield. And so there's a high degree of execution risk that comes along with that. Really, particularly on the exit. You could be a
Sure.
great operator, but you got to have somebody to sell the building to at the end of your business plan, and you have to have a market that can weather, a downturn or whatever economic cycle. And so, just another thought there, for people to be aware of right now. So,
Yeah,
you
nothing
know,
goes up
so
forever. So
yeah, exactly, exactly. And so, that's the thing right now is with the level of competition in the space, with the high demand for the asset class in general. We talked about this on previous shows where, COVID really proved the resiliency of multifamily,
mhm.
and then you saw the immediate response from the government to step in and provide fiscal policy that supported both renters and multifamily owners to make sure that people weren't getting displaced. It was one of the really only investment verticals that were getting government support to make sure that lights stayed on and people were staying in their homes. It just really proved the resiliency of the asset class, which is, and if you look at the people that are in the retail space, hospitality space, all these people that were significantly impacted,
Yep.
they're looking for more security. They like that security, and so all of those factors now are creating this incredible pool of competition that is only going to continue to further accelerate the asset valuation that we're seeing, the demand for the product. But it's also forcing people to get more creative in how they're operating their businesses, more creative in how they're structuring their deals, more creative on the markets they're going to. And that's where just things really need to be put into perspective and really be thought out intentfully before making an investment. And I would encourage passive investors listening to this episode too is, again, the conversation around yield is something that's very important. The days of 10% cash on cash are all but gone. And I would argue that if there's a deal that's out there that's producing a 10% cash on cash, or crazy X multiple, whatever it is,
It's hairy for sure.
yeah, it's hairy. You might want to be asking some questions on that deal. So you know, so the point is for anybody that's tuning in today, looking for an investment opportunity, I still think this year is going to be a great year to buy. I think there's going to be a lot of opportunity, but you need to really ask yourself, what is that risk adjusted return worth to you? And what is that risk appetite worth to you? Because, you know, I think that there's a lot of great operators in the space, and there's a lot of experienced operators in the space that are still having success with value add. Not to say that there's not, but I think that there needs to be a more cautious approach going into this market cycle. And look, we talk about this too. I don't think this is going to slow down anytime soon. I don't think this is going to change just because interest rates are rising, or Fed monetary policy is tightening. The demand for the space is still going to be here. You know,
Absolutely.
so
And there's a lot of
that's
other there's some other things I think to consider and kind of highlight too with the value add play and versus some other classes. And one of the things that we're dealing with and seeing in the market today is rising rents across all classes, right? I think here in Houston, A class did the best percentage wise year over year in 2021. B and C class still had a phenomenal year, and there's obviously still rent growth going on across the nation. A lot of these assets, especially these C class assets, they're starting to push rents to unknown areas that have never been touched. A C class asset renting for 11, 1,200 bucks a month is just, again, unheard of for a one bedroom or a two bedroom. So we're starting to get to a point now where there's a new sort of bottom floor, and we're breaking through an old ceiling. Now that doesn't necessarily mean that's a bad thing, but the question then becomes, is our wages in that market, which is why understanding the market is so important. Are wages in that market reflective of the ability of the tenant to be able to afford that apartment, even as a C class asset, right? Affordability is something that people have to think about. And when you're thinking about A class versus B class versus C class, and we were talking a little bit about COVID and how that sort of impacted the market as well. Understanding that and how some tenants can't afford those rents anymore, and the C class tenants are the ones that are going to be more likely to struggle if there's economic issues, if COVID were to come back, or there's some sort of recession. You're going to be dealing with more collection issues in the C class asset versus the A class asset. And then also on the to tie in with that, with wages going up, C class wages are going to start being a larger and larger percentage of your overall take home income, so that your rent, you might be paying 30 or 35% of your total take home pay might be going towards your rent. And that's a really risky position to be in as a C class tenant versus an A class tenant, which might only be paying 19, 20, 21, 22% of their income as rent. So there's all those variables to kind of consider with affordability. You can't just push rents to the roof on any asset class. And I think it's important that you understand the market and where the rents are going before you make an investment decision as well.
Yeah, no, absolutely, absolutely. So the overall theme again is approach with caution. Especially when it's a true value add opportunistic opportunity right now. There's all these different variables between the market, the business plan, the strategy, the operator, the debt. The debt is so huge right now, especially going into this capital market cycle that we're about to go through, and rising interest rates, the demographics, all the above. I mean, look, the basic fundamentals are still here. The basic real estate fundamentals are still in place, but you just got to be more cautious in what you're getting into right now. And so, experience is key, education is key, and really, asking questions, asking the right questions too, I think is going to be important. So, I hope the audience finds this valuable. I hope that, our passive investors tuning in today really take this into consideration, and reach out to us, reach out to us to talk about this in further detail. This is something that we're very passionate about, because this is something we fundamentally believe in. We do believe that, it's still a great market cycle to buy, but looking at more the risk adjusted return and risk adjusted basis for what we're buying. And so, I don't know, Brian, closing thoughts?
I would say getting educated and asking questions is key in any opportunity. If you're looking at an offering, and don't just brush things off. Don't look at that and go, "Oh, that's A class. You can't invest in that. You can't make money. There's no value add." Well, that just means you're not doing enough research. You're not educating yourself enough on the potential upside, and then you're not weighing the risk of that potential opportunity. If it's a C class deal, same thing. Don't look at it and go, "Oh, 10% cash on cash with a 8 pref and a 2.5x multiple. Where do I wire my money?" Just looking at the numbers, right? So you really got to understand the operator, you got to understand the market, you got to understand where the rents are going. Can the tenants absorb that rent? And then what's the execution risk involved, both on the cosmetic side with the capex injection, both on the debt side, what type of debt is being leveraged for that particular opportunity. Just go in asking a lot of questions, and be educated about the overall business strategy that's being presented to you. And none of us have a crystal ball and know where it's going, but we all need to make the best educated decision for us and what our personal investing thesis is. If you're a value add investor and you're really chasing that cash flow and that yield, then stick with those opportunities. Just be educated about what type of questions you need to ask and have the risk tolerance for it. If you're leaning more towards wealth preservation and equity upside and just looking for those tax benefits, and cash flow is important, but it's not the most important thing for you, then you might be leaning more towards the A and the B class where there's less execution risk. You're going to have a little bit less exposure if things were to turn south because of the quality of tenants and the affordability of tenants in that particular marketplace. And really just weigh it out. Maybe if you invest a lot, balance your portfolio. Invest in an A class and invest in a C class. So if something were to turn, at least some of your portfolio at least has a little bit of stabilized assets in it. So that would be my final piece of advice to someone who's looking to invest.
Yep, I couldn't agree more, man. Well said. Well said. Great way to wrap up. So, all right, guys, you know what to do. If you love what you're hearing today, and if you are interested in passively investing in some of your core plus product right now, your stabilized opportunities, make sure to hit up Brian and I, Cody or Brian at blueoakinvest.com. If you want to get on our preferred investor list, you heard it on the intro, www.blueoakinvest.com/investor-forum. We'd love to get you on our list, show you what we're working on, and talk through our investing thesis for this year. So with that, we'll see you guys next week.